It's fitting that on National Popcorn Day, you'd have stocks popping higher. We see the S&P 500 reach an all-time high today. The bulls are running once again in 2024, but will they stay? Welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and my partner and co-host, Tobin Smith, seems to be away on assignment. Who knows? He's missing in action. We're sending out a crew to find him. But regardless, we're going to have a show. Barbara Doran is our featured guest today. She is the CEO and CIO of BD8 Capital Partners. Barbara, welcome to the program.
Todd, delighted to be here. Thank you.
Absolutely. I got to say, you're back again. The first time you were with us, it was a few weeks ago. I don't know, maybe 10, 12 weeks ago. You really called the market. You really saw how the stocks were going to end the year in 2023. Here we are in 24. I gotta say, it's kind of been a little bit of a ho-hum time. We missed the Santa Claus rally. Yet this week alone, we see stocks are rising a little bit more. You had a big update today. Consumer sentiment looks solid. But what do you think, Barbara? Is this bull run going to stay for the time being?
Yeah, I think it is. I mean, if you remembered last year, at the beginning of 23, people were very pessimistic. There'd been so many calling for a recession for months before that, and they were sure in 23 we'd have that recession. Well, we know how that's played out. Inflation continued to come down, if haltingly, but you saw it was 6.5% in December of 22, and by year end 23, it was down to 3.1%. So the pessimists were not well positioned. So I think there was a huge catch up rally as we saw in the fourth quarter. And part of it, you just saw not only the mega cap stocks, which had the mega cap tech, which had been outperforming given how they were trashed the year before. And that was very painful because I own a lot of them, but it was also, you had big breadth in terms of small cap, industrial, cyclicals. It was everything. And people thinking, oh, we've got the breadth trade, finally the market's going out. Well, coming into January, people no longer were thinking recession. The consensus has been soft landing. And I think a lot of investors expected to see a pullback, which would be totally normal after such a big run. And I expected in the mega cap tech names. Instead, what's happened, you saw, small caps, the Russell 2000 gave up half its gains. You have not seen the rally broadening out. In fact, you saw the old leadership, the tech names, resurging and doing it again. Like I think Nvidia is already up 20% year to date. This is only 3 months into the new year. Yeah. So I think this has surprised everybody in terms of just the short-term market volatility. But I think what's happened going into the new year, we thought, okay, that we really feel confident the Fed is done hiking, given what we've seen with inflation, the economy's holding up. Then it was really the uncertainty. What's become uncertain is, well, we thought maybe they would hike or they would cut rates quickly and starting in March. Well, the probabilities in March, the Fed Fund futures has gone down from 70 to 43%. And I think that's way too high. I think it's going to be pushed out. And the reason is simple. One, the Fed would cut if one would look like we were tanking and going to recession, horrible things were happening. That's clearly not happening. Two, they would cut if the real rates were going to be too high and if they felt inflation was beat. Well, we're not sure inflation is licked yet, because if you're looking at economic strength, we had, as you just mentioned, consumer confidence numbers this morning were the best in decades, or the best, and not the best, but in percentage terms, the biggest jump in decades. So you had expectations for inflation coming down, both now and in the future. That's important because that affects spending decisions. You saw retail sales, better than expected for December. Jobless claims last Thursday, which comes out weekly, they were less than expected. And jobless claims are a leading indicator. When you start to see that jump up, then you start to go, wow, we're really starting to roll over. People are getting fired or laid off. So what I see is you see a pretty strong economy. It is moderating. But, one thing I'm thinking about, Todd, and not a lot of people are talking about, on the housing, you've seen what's happened in this, rates peaked. Mortgage rates peaked at 8% in October and probably averaged 7% last year. Right now, as of last week, it was 6.6%. And you have seen a big perk up week to week in refi applications, new sales pending, all this sort of thing. And so if people start to, to move into there, and I think they probably will, because when you start to see rates coming down, and you also see there's something like 10 trillion in untapped equity in people's homes that could be used. And you saw buyer intent up 10% in December. So if that starts, that has a huge ripple effect on the economy. So you lots of strength coming. And so I think the inflation numbers are going to be key. PCE, the Fed's favorite inflation indicator next Friday, will be important. But core PCE is averaging 1.9% the last 6 months. That means they've met their target at least in one important way. So
Well,
this could be an incredible time. Inflation's
it,
being beat and
it
we've still got an incredibly healthy economy.
yeah, I have to
Yes,
agree
I'm
with you
bullish.
there. Yeah. There you go. You are bullish, and that's
Yes.
wonderful to hear. I will say, and I do agree with you that it's great to be bullish. There's so many factors that seem to show us that okay, you have inflation is coming down. It isn't you're right. The PCE might be a 1.9 in the last 6 months, but overall, when you start looking at that CPI number, which is the number that really is on the headline of the Wall Street Journal. And that's what investors are looking at. That's what Americans are looking at. But realistically, though, it doesn't seem like we're ever going to hit that 2% target, at least the year over year number 2%, because the Fed will actually start cutting rates before we even reach that level. Because if they wait till that level, let's be honest, it's probably going to be too late anyway. What are your thoughts on rate cuts? Because that is a big piece of this whole puzzle as far as keeping that bull run going.
Yeah, it really is true. And interesting you mentioned the CPI last week because CPI was a little bit hotter than expected, although core was not. But the very next day you had the PPI, which is wholesale prices, and
That's
that is
right.
actually better leading indicator than the CPI because for obvious reasons it's wholesale. What's going on in the chain before it gets to the consumer? So you may have an interesting, possibility that the Fed does not need to cut rates that much, and that the economy keeps chugging along, given wages and employers seem reluctant to let people go as quickly as they did in the past, given the pain that you just went through in trying to find people. So I do think they're going to push off any cuts until second half of this year, although probabilities people are giving a higher probability, like 80% in May. But they may, just as insurance, depending what, and they keep saying data dependent, they are indeed. So if they start to see more things rolling over, because we've had a ongoing recession in manufacturing, those numbers are not improving. Housing is a problem because there's such a shortage of existing homes for sale because so many have 3%. They're not going to pay 6%. But once rates start to come down, that will loosen up, and that's going to really start the economy, really an additional growth leg, as I said, in the economy. So we'll see if inflation started to heat up as a result, the Fed
Yeah.
then would hold steady. So I'm not sure we're going to see big aggressive rate cuts this year. We will
Yeah,
see some likely, but it's not looking like we will, given the current set of data we have, which can obviously change in a few months.
I completely agree with you. I don't understand where people are thinking that it's an automatic conclusion that you're going to see rate cuts. I mean, the consensus just a couple of weeks ago was that March we were going to see rate cuts, and it just doesn't make any sense, especially with the labor market being as healthy as it is. You mentioned jobless claims numbers are down. I mean, we still get that monthly jobs number that seems to be very healthy. And so when you see that, it's hard to understand why the Fed would actually start cutting rates. I will say this, if they do wait till the second half, then they're at risk of really looking like they're favoring the incumbent. And it is an election year. So it's interesting. I wonder what the discussions are because they can't talk about, they're not going to publicly talk about politics, but they're in Washington. Of course, they're talking about politics. So as a result, do they cut earlier or do they wait until after the election? I think that's where the real conundrum is in all of this, because I'm certain that the Fed figured, hey, we were going to have such a slow economy with very limited job growth with the rate hikes that we saw. We just haven't seen that so far. So, but I like your conclusion though with that. When
Yeah.
you're talking to your clients at BD8, I mean, are they still? We talk about, and you touched on this, the amount of money on the sidelines. It's $5 trillion sitting in money markets. Do you see your clients? Are they asking you saying, okay, should we deploy this money? Are they really trying to get in it, like they're that FOMO trade where they have to be involved?
Well, that's always the key thing if you start to see FOMO. But no, there's still PTSD from 22. I mean, that's when
Okay.
neither stocks nor bonds, perform particularly well. And particularly if you're in growth names like I invest in, because that's it, over the long run, I believe the way to create true wealth. But so no, I have clients still PTSD, and don't want to go chasing things, but we are still primarily in stocks. And there's some cash accounts that, we're getting our 5.3% yield, whether it's through a money market fund or short-term treasuries. And I think that's also a question in terms of, it's actually, I think, closer to 6 trillion in money market funds. And that it was 5 trillion a year, a year ago. So you do have money that can roll in. And I think some of that would go to longer duration fixed income, because that's you want to lock in rates before they come down, dramatically. And also some will go into equities because there will, and I think that's what you saw at year end, a lot of people rushing to get positioned because, you want to show that you own, some of these great names. So, but I wanted to get back to you had mentioned this point about the election coming up. As far as,
Mhm.
I mean, whoever knows what's going on behind the curtain, but this Fed, and I think the Fed chiefs in general have tried to be as apolitical as possible, right?
I agree.
Yeah, and I think that Powell has demonstrated an amazing amount of integrity. There's also all the Fed presidents in the different regions are allowed to speak their mind. They're not speaking just the company line. They give their honest and opinions, and they're all varied. And the message, though, has been number one, they are committed to fighting inflation. That's why I think, they are not going to cut rates anytime soon, meaning in this first half, because they do not want to blow that inflation. But at the same time, I've heard them all along be very aware that it's a dual mandate, jobs. We want to make sure Americans are employed. So right now, and people ask, is there still the lagged effect from last year's hikes? Doesn't look like it. I mean,
Mhm.
who really knows? But I think that the Fed will continue to go cautiously. And if they need to cut rates because it's looking like that balance, is first off, it may be that things continue as they are good growth, inflation coming down. And then at a certain point, as you just said, you do want to cut rates. The real rates then would be, if they got down to their target rate 2% and the Fed fund rates were still 5.25, that's 300, basis
Yeah.
points of real restrictive monetary policy. And that would start to bite at some point. So
Yeah.
I
I
think if
agree.
that would be a good reason to have to cut, so that, but we'll see. I think the PCE and the inflation data in the next few months is going to be really important. If it sort of stalls out, we saw it last year. There was sometimes like we had last week, a little blip up, and then
Yeah.
it would continue. It was like, this. So, I think that's will determine. I think it's hard to know right now, how the Fed will.
Okay.
I don't think they would keep the election in mind. If anything, they'd want to avoid the appearance, but in the end, they would, I think, decide to do the right thing as they see it.
Well, that's the tricky thing. I mean, you're
Yeah.
absolutely right. They need to stay away from any hint that they are doing anything on behalf of a presidential candidate. And yes, if they start cutting rates, I mean, markets would just soar, and then you'd have the wealth impact and all of this stuff, and that really will help. As you know, Barbara, people do vote
Yeah.
with their wallets, so
Yeah.
that would be
Well, that
something
was
to think
wasn't that
about.
interesting, Todd, this morning, though, what you're seeing, and there was even an article in the Wall Street Journal about people are finally feeling more confident in the economy because it takes again this PTSD thing, I mean,
Mhm.
COVID being in lockdown and all that had long lasting effects. And I think it takes a while, much longer than we thought, to unwind those emotional effects and really get back to normal. But there's also
Yeah.
an interesting thing that in 16 of the last 16 presidential cycles, meaning the year of the election, the market was always up 16 for 16.
Wow.
So,
That's great.
yeah. So hopefully this will, for the investors amongst us, that will continue to be true. But I think it will. I think it
Well, yeah,
will.
I think you're right about that. I mean, a lot of the strategists that we've had on lately have really talked about how this is an election year. History points out that when you have an incumbent trying for re-election, it definitely helps the markets. But well, time will tell, and we'll see what happens. So let's leave it on that block right now because I have to ask you, and I'm guessing I mean, our search crew, what I understand, they're still looking for Toby. I'm gonna guess that he probably went away for the weekend. He's probably traveling somewhere. So I need to ask you about travel and leisure stocks. I got to get your opinion there when we come back.
Oh,
So with us today is Barbara Doran. She is the CEO and CIO of BD8 Capital Partners, and we'll be right back after the break. Please stay with us. All right, that was.
Buy, hold, sell, brought to you by CrossCheck Management.
Ready to up your game and learn more about the thrilling world of sports betting? Introducing Double Down with Breslow, the ultimate podcast about the business of sports gambling. Join me, James Breslow, and a long list of expert guests as we dive into the art and science of the sports betting industry. Evolving regulations, technology enhancements, and the meteoric rise in the number of players makes this sector the fastest growing and most intriguing in the world. Unlock the business secrets from many of the industry's most recognizable C-suite executives, including famous odds makers and influencers. Every episode of Double Down with Breslow is packed with insider tips, deeply skilled analysis, and in-depth discussions. Don't miss out on the ultimate resource for mastering the business of sports betting. Listen to Double Down with Breslow on the Evergreen Podcast Network or wherever you listen to podcasts. That's Double Down with Breslow, the business of sports betting podcast.
Welcome back to Buy, Hold, Sell. Well, still no word about Toby, so we're just going to let him go and not even worry about him because we're just going to assume he is traveling and having a wonderful time because he is missing his assignment on this show. But that's a whole other story. But with me today on this one-on-one interview is Barbara Doran. She is the CEO and CIO of BD8 Capital Partners. Barbara, you have been on the news. You're on CNBC Weekly. Everybody's talking about you because you have so many great stocks, so many great picks that you share with your clients. I got to ask you about travel and leisure, though. What do you think? Because here we are, we're going into the spring months. You got spring break, you got summertime coming up. Everybody wants to get away and get out of the cold. What's your thoughts, though, on that sector?
Well, it's interesting, Todd. It's been a great sector, whether it's in the hotels or cruise lines. It's been super this last year. And airlines. Airlines is more problematic because they're much more susceptible to cyclicality, like in oil prices. But I think the cycle has more to go. There's still a lot of pent-up demand. And if you talk to any of the operators in any of the categories, they still see very strong demand. However, I think at some point this demand is going to normalize. And I had sold at the end of last year, a month ago. I have positions in Expedia and Airbnb that I'd held. And Expedia I bought last year because it is a competitor to Booking.com, which is a great name, which I also own, but it was half the PE. And for good reasons. Their growth rate was half of it, but they had all these initiatives in terms of marketing and getting things organized on the same platform. So there was a sort of one of these self-help stories. But I had a double in the name. I looked into this year, and even with the Fed, the anticipation of the Fed being done hiking rates and probably cutting at some point this year, I thought that travel is going to normalize. And I didn't want to be, caught in like, oh gosh, Peloton or Zoom. Zoom I had owned and unfortunately wrote it down a little bit after the pandemic and gave back some of the gains, not all. So, I wanted to be careful here. So I sold probably half my positions in Expedia and Airbnb, great names that
Okay.
they are, because they both, from when I bought them, had doubled. So I still own some of them, but I think this is where it's that whole question of risk management. When positions get too big or you anticipate a possible change, but you still think there's more to go, what do? Often you just
Right.
reduce position sizes. So I think if you're in these names, you can stay long, but I think you should start to trim positions because, the travel demand will start to normalize at some point. But I think
Yeah,
probably this year.
I would think it would. I mean, right? I mean, we've been hearing the studies that you have a lot of people that are the corporations are telling their people, look, you can have the hybrid model, but the majority of the time you got to be in the office. Plus, you have travel that's going to be happening. And I can see that, especially with industry conferences really ramping up this year. But I have to ask you though, with the airlines. As you know, there's the Boeing 737, the Alaska Airlines flight that took off from Portland, Oregon. It reached 16,000 feet and then had the blowout on the side because of the faulty plug. What are your thoughts on Boeing? Because that stock got crushed once that news came out.
Yeah. And, frankly, I had owned Boeing from a couple of years ago, thinking that once the 737 MAX, all the stuff from the accidents, they'd done a lot of damage control. I thought the stock was cheap. And it just was way too early. As you know, they kept having one misstep after another. And I finally kicked out, most of it sometime last year. Well, then, of course, is when they finally started to get their act together. You saw China recertify, they started to execute better. And it looked like, and I was watching it run up going, I should have been a little more patient because the cash flow, they're looking at cash flow of about 10 billion estimated for the 25-26 timeframe. Well, of course, then we have this door blow off, on a couple of weeks ago, or more than that at this point,
Yeah.
and which really sent the stock down, to about 230 at first. And people thought, okay, we'll see, this might be a one-off. And then, of course, the hounds, saw blood in the water, and just, jumped on it. And so there's more delays when the FDA said they are not the FDA, but the FC, which one is it?
FAA.
Yes, thank you. The FAA,
One
FCC,
of them.
yeah, one of them, one of the Fs. Anyway, that they would do even more thorough inspection. I think people just ran for the hills. And so the stock got down to 200. And I thought, okay, even though we don't know how extensive it will be, it's not going to derail. The stock was off 23% from its high at the start of the year. So at that point, you go, it is more than discounting whatever bad news lies ahead. So I think there was a good buying opportunity in there. Now, I think what's going to happen, you'll probably find but it would just be a guess, that it's not a deep systemic issue that's going to ground all their planes forever and all that sort of thing. So it probably still is a buying opportunity, but that uncertainty will keep the stock under some pressure. But I do expect it, it's probably going to be good news and working its way back up. Probably should get back to at least 225, 230. And then depending, once people can analyze the extent of the damages, in terms of long-term grounding, it could get back to its high and go even higher.
Yeah, that'd be a really nice gain. I mean, that'd be 15% off of these current
Well, yeah.
values.
And
But
when you see, yeah,
and I will say with Boeing, the question would be whether you have these companies that go out and lease these planes, and they're the ones that are actually buying the planes. If they start switching and saying, you know what, forget Boeing, we're not going there, we're going to Airbus, then that's a reason for concern. But I think you're right, though. There's so many contracts, and these contracts, especially on the Defense Department side, they're years out. So a lot of these deliverables that are going to be happening will be going on for many years, and that can only help their stock overall. So hopefully this is just a one-off. I mean, thank goodness the plane wasn't at that cruising
oh my gosh,
altitude of
yes.
40,000 feet. It definitely would have had loss of life then. But with that, hopefully they did solve the problem and fixed everything, and we'll see how that goes from
We
there.
will.
So with that, so that's on the travel and leisure side. I am a big fan of the hotels. I love Hyatt, Marriott. I think those are your go-tos. They almost like an Exxon for oil. I mean, if you're thinking of companies, just want to buy them, hold them, put them away, like baseball cards, and then reinvest the dividends, do the Charlie Munger way, and you should be okay. But what about other sectors, though? Or other industries, other stocks? I know you mentioned Starbucks on CNBC. It was enough for me to go and make a Starbucks coffee, and so I have to ask. I mean, what makes you like this stock so much?
We know it's been a core holding for my accounts for a while, but some have been a little bit underweight, and I've been waiting to see because I really started buying it when you could see all the initiatives that they're doing. Howard Schultz retired, and I think he retired. He'd been called back into action because he felt that the company was in good shape and being in good hands. And they've had a number of really positive initiatives in terms of introducing food and innovative drinks and having custom ordering remotely, so you can just come up and pick and not have to wait 10 minutes for some barista to make you coffee, and drive-throughs. In fact, new Starbucks that they're opening, and they have a very aggressive store opening plan, will have drive-through, almost all of them. And they also had a big China plan, because China was not so much coffee drinkers as tea drinkers, but that has really changed. And so, what happened with the Chinese lockdown was so long, and it was a while bouncing back, and they had a very promising restart when things opened up. But it's been a little bit disappointing since then. And China has some deep macro economic issues, but the government is not sitting there twiddling their thumbs. They're obviously going to be doing a number of efforts to stimulate the economy, and that should help Starbucks. And so I think at this point, when you look at their valuation, and what the earnings projections are, which is maybe 15%, for the next 2, 3 years and beyond, given a combination of new products, store openings, and all the things just talked about. But it's also at the low end of its forward PE range. It's just under 24. It's typically been, if you look at the last 5 years, as high as 36. So it's been somewhere, the average has been around 30. So I think the risk reward here is very attractive. And I think it's the type of name that as we get into the year and people are looking, where do we find, attractive risk reward situations? I think Starbucks, any bad news or uncertainty is already discounting the stock, and there's real upside should things start to turn, and you'll start to see same store sales improve and that sort of thing. So that's why I'm a fan, and I've been adding to my positions and bringing them up to full weighting now.
Yeah, I'm a fan as well, and not just because I drink coffee all the time, but I will say that the food side is great. I mean, obviously their coffee margins are, I mean, I'm probably pushing 30 to 40%. They're almost like the Apple of coffee companies. But when you look at the at home items, these, I'm not sure if you have one, they're called Nespresso machines. You can't go to a store and find these Nespressos. And Starbucks has cornered the market. You can't find a non-Starbucks capsule. I guess you could go directly to Nespresso, but for the most part, Starbucks has those, and they're crazy expensive. So I would imagine that the margins there are probably 30 to 40%, and they are just selling off the shelves. So I see that as a big thing. The other side of it is their collaboration with Target. They are a store within the store, and yet they have Target employees that have to go and hand deliver. They actually, just like a drive up, if you buy a vacuum cleaner, you can have a latte. Somebody can walk it out to you, and Starbucks doesn't have to pay for that labor. I mean, it's an incredible service, and it's only meaningful to their bottom line. So I have to say that is definitely a winner. Not just this year, I think beyond. I mean, because nobody's ever been able to counter them anyway. So I like that one. What other stocks are you looking at? What, I mean, tell me, because I mean, we got the whole year, and I know our audience. They're foaming at the mouth. They want to know, hey, what do I invest in now? But what
Exactly.
else do you like?
Well, I mean, goes without saying, Nvidia, and people go, oh, it was up 240% last year. It's already up 20% year to date. It has so much more to run, Todd,
Yeah,
because earnings will keep coming up. You saw the Meta news, yesterday talking about how many CPUs they are buying from them.
I
I
know.
mean, just Meta alone is huge. And we are still in the early innings of implementation
Yes,
of AI. And if you heard some of the reports from Davos, there'd be a room of 100 CEOs, and they were asked, well, how many of you are, where in of AI, 100%, of course. And how many of you are going to be implementing this year? 65% are already moving forward. And we haven't even begun to see the applications and the tools and the things that will be dreamt up to make use of AI. So, and that's why, look, oh, and that ties into Apple, because Apple's been very controversial this year because, their handsets are slowing down, da 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 da. And so you've had a couple downgrades on the street. I think two people upgraded in the last few days. And for me, it's a clear buy. The stock had sold off. It's one of those core holdings, and it's a couple reasons. One, when they talked about the handset market slowing or the handset slowing for them, well, that's temporary because you're going to have AI integrated. You're going to have new uses, and we're also heading into the replacement cycle. For handsets. So I think that should help. And the most important thing was probably the increasing percentage of revenues from services. And services is huge high margin business. And that's gone from 15% of revenues 5 years ago. It's now 22% and climbing. And, it's the ecosystem. I don't know about you, Todd, but, I had bought an iPhone some years ago. Then I was like, it would be nice to have the computer and everything coordinated. So I made the incredibly painful transition from Windows to Mac. And then, of course, I now have my Apple Watch,
right.
because of exercise and all the health benefits, which will continue to increase. And so, people are loyal, and there's 2 billion devices out there. So Apple
Yeah.
ain't going away. And as you know, they generate huge cash flow that they return to shareholders, and that's not going away. So I just think it deserves a high PE, no matter what's happening with handsets in any given period of time. There's going to be lumpiness, in that. It just, goes with the territory. But
Yeah, no, I do definitely agree with you on that one. And we had Dan Ives on Buy, Hold, Sell not too long ago, and he did talk about how in 2023 you'd have a number of S&P 500 companies that really had 1% of their annual budget devoted to AI. Now the number's close to 10%. So when you start seeing those budgets, that type of increase, that type of commitment to AI just on the corporate space,
yeah,
we haven't
yeah,
even talked about on the individual space. That's a whole other avenue right there. So I do agree. NVIDIA is definitely going to be the winner, not just this year, probably for many, many years, especially with their growth rate. It's just so eye-popping. So, and Apple, you can't go wrong with Apple. I mean,
no,
people don't wait out in line all night long for a Samsung product, but they do for an Apple product. So
no.
that tells me that's the stock you want to own.
Yes, you're not kidding. So, and then
Absolutely.
also, it's not, these names are not undiscovered, but, people say, oh, it's a crowded space, but you have so much more to come in terms of earnings. Like Palo Alto is also a core holding. And that's, as we know, is the cybersecurity play. And we also know what's happening in cybersecurity. It is going to be a huge, long tailwind in the secular space. And they are number one, they've got the platform with best in class, different security products on it. And big enterprises are moving. They want to consolidate. They don't want something from this person that doesn't talk to each other. And so they are just gaining share and they still have a minimal share. I mean, it's a very fragmented market. So they've got growth oh my gosh, for the foreseeable future. So that is also another one, you look at where it's come from and the PE, but it will continue to outperform.
Yeah, yeah, I like that a lot. I know the audience does as well. So Barbara, we're going to leave it there. We have a lot to look forward to this weekend. My Ravens are playing, so go Ravens. We root for the Ravens and see what happens. And hopefully, when we come back for Buy, Hold, Sell next week, I'll be smiling. So we'll see. And I'm sure
Well,
Toby
good
will come
luck.
back with a nice tan. So
All
we'll
righty.
see. Barbara, how can the audience reach you?
Well, they can call or write, my cell phone number. Should I give that out?
No, don't do that.
No,
But I'll tell you what. What's your website
I do
address?
have
What's
a
the URL?
website. I do have a website. That's probably the best way. BD8cap.com.
BD8cap.com, and we
Although,
will have that in the description as well for everyone.
yeah, you
We
know what? I should check that. I don't even know my own website. Let me see. Oh,
Oh
how
my good. Well, you're so busy as a CEO and CIO. You're wearing two hats. There's a lot to go on there. So I can
just tell them to
understand.
plug in BD8 Capital Partners and they'll find it. So,
BD8 Capital Partners, Google that.
right.
I'll also look it up and I'll put it in the description. Definitely encourage the audience to go talk to Barbara. She is very wise. She's not on national TV for nothing. She definitely knows her stuff.
Well,
So,
Todd,
Barbara, I got to thank you for joining me on Buy, Hold, Sell. And next
yeah,
time, hopefully, we'll have Toby with us as well.
little bait and switch there. Where's Toby?
Yeah,
I loved
right.
it.
I
I'm
know.
glad to have you all to myself, Todd. Thank you so much.
Oh, fantastic. That's awesome. So, on behalf of Barbara Doran, I am Todd Schoenberger, missing Toby Smith today, but thanks once again, and please join us next week on Buy, Hold, Sell. We have Sylvia Jablonski, CEO of Defiance ETFs, will be coming back to the show, and you definitely don't want to miss what she has to say. She has some great products that are just hitting the market, actually, over the next couple of weeks. But we'll get into that later on. Everybody, have a great weekend, and go Ravens. Take care now. All right, that was good.
Buy, Hold, Sell, brought to you by CrossCheck Management.
If you like Buy, Hold, Sell Live, be sure to smash the like button.